Well, friends, we'll start today's class. In your previous session, we are discussing the concept of error and fraud in the context of audit. We'll continue with that. Welcome, all of you. I'm going to share the screen with you. Just bear with me for a moment. Are you able to see the screen now? Are you seeing the PPT
Yes,
file?
sir. Yes, sir.
PPT file. Okay. Yeah, please keep your system in mute mode if there is some background noise. Otherwise, you can unmute it. But in case there is some background noise, please mute it. Yes, friends, in the previous class, we have already discussed what is error and what is fraud. And in that context, we already know that errors are generally unintentional and fraud is intentional. That concept we know. And we have also discussed various reasons of error and fraud. Mostly reasons we have already discussed. And this particular chart also we have seen in the previous class that in a error situation, in a fraud situation, whether auditor is negligent or not, how to find it out. So this chart explains us various tests has to be made like this, whether auditor has exercised reasonable skill, whether the error or fraud could have been detected in ordinary course of checking, and whether there was any reason to suspect. And one more thing, whether the fraud or error was deep laid. So these are the issues or these are the questions which needs to be asked in that situation. And on that basis, one has to draw a conclusion whether auditor is negligent or not. So these concepts we have discussed earlier. And coming to reasons or circumstances, there might be, these are the list of circumstances. And you can say these are the possible reasons of error and fraud. Maybe ignorance of generally accepted accounting principles, maybe one reason. Carelessness in doing accounting work, that may be another reason. Desire to conceal shortages or defalcations or misappropriations, that may be one more reason. Tendency of the management to permit prejudice or bias to influence the interpretation of the transaction, that might be one more reason. Management may be biased or prejudiced to a particular view, towards a particular view, and consequently that view may be reflected in the financial statement, which is an error, which may be an error or maybe a fraud. Desire to minimize the tax also, maybe sometimes that may lead to fraud, because to minimize the tax, the organization may have taken some steps to reduce the profit, right, by let us say overstatement of expenses or understatement of incomes. Ultimately that leads to this thing, misleading presentation or misstatement in the financial statement. Intentional efforts, some people make some intentional effort to alter the position of the so by using their authority. They might be willing to show up the picture or maybe depress the picture, or might be to convert the situation to some personal benefit. Let us say one person is entitled to a commission on the basis of profit. So naturally that person will be will be interested to show a higher profit. So in that case, what will happen? The financial statement figures may have effect on some personal benefit. So in that situation also frauds and errors may occur. Yeah. And we have also discussed these errors. I think all of you know what is the meaning of self-revealing and non-self-revealing frauds and errors. Unintentional, unconcealed, and concealed, and errors and fraud that affect general ledger balance and that do not affect general ledger balance, or procedural errors. These are the various kinds of errors we have discussed earlier. Is it not? Yes or no? What is intentional? What is unintentional? And also we are discussing the concept of teaming and lading. These are the various possibility, various kinds of fraud relating to defalcation of cash. These things we have already discussed earlier. Misappropriation of goods, misappropriation of accounts, this concept, concealed and unconcealed error. Procedural errors also were discussed. Okay, coming to various types of errors, also errors of omission, commission, compensating errors, errors of principle, procedural errors. We have discussed all these things. Do you have any doubt on this?
No,
Any?
sir.
No doubt. Okay, right. Now, coming to auditors' responsibilities relating to error and fraud, quickly recapitulate this concept. This is we have to deal with SA 240, which deals with the primary responsibility of the auditor. So, primary, we need to understand the, as you already know, people who are charged with the governance of the entity and the management, they are basically responsible to prepare the financial statement in such a way that they're free from any error and fraud. Okay, and auditor need to obtain a reasonable assurance that the financial statements are free from material misstatement, whether it is caused by error or fraud. So auditor, what he does, he applies certain audit procedures to ensure that there is no material misstatement in the financial statement. And that material misstatement could be caused due to error and fraud, but auditor considers both the things. The risk, one more thing, or all of you definitely appreciate that the error of not detecting a fraud is higher. Are you agreeing or not? Or you can
Yes,
see
sir.
the risk of not detecting a fraud is definitely higher than the risk of not detecting an error. Error can be easily detected because they're in fact unintentional. The person has not taken any extra step to conceal it. So that can be easily detected. Is it not? But the risk of detecting a fraud is definitely higher. That risk is always there. And similarly, in the judgment areas, can you give me an example of judgment area in the financial statement? There also it is difficult to detect an error or fraud. Let us say you are estimating the life of an asset. Here you have to make an estimate or make some judgment. There also it is difficult to detect because management is involved in those kind of judgments. Is it not? Auditor being an independent agency, it will be a little difficult for him uh, to detect whether in that judgment there is some error or there is some fraud. And again, management fraud is difficult to detect than employee fraud. Employee fraud can be easily detected, but if the management purposefully commits a fraud, commits an error, then it will be difficult to detect. Are you agreeing or not? Management fraud is, if fraud is committed by the management itself, the organizations, the entities, management is involved in the fraud, then it will be difficult to detect. But when employees is involved, then it can be detected. When management is involved, then what happens? Internal controls may not detect. Okay, there are many people in the management who can override those controls. So it will be difficult to detect that. But in all the situations, it is auditor who is responsible to maintain an attitude of professional skepticism. Throughout the audit, he has to maintain this attitude. So reasonably, he have to, in every situation, he have to see he needs to collect a reasonable evidence to support, to verify, to see that the financial transactions are correct. Transactions are reflecting true and fair view. Okay, and he needs to maintain an attitude of professional skepticism throughout the audit, considering the potential for management override of controls. So auditor knows there is a possibility that management may override the controls. Controls are there, but there are many positions in the management who can override the controls. Auditors should keep that point in his mind. And also auditors should recognize the fact that the audit procedures that are effective on recognizing the error may not be effective in detecting the fraud. Let us say particular audit procedure auditor is applying. Auditor is suggesting, okay, if you want to verify the bank statement, bank balance, you can ask for the bank statement. So normal process, if bank statement is, bank balance is compared with the bank statement and bank balance is reconciled, or bank statement and bank ledger are reconciled, then you can assume that the bank position, the bank balance is correct. Okay. So auditor applies that procedure. Auditor verifies the bank reconciliation statement. Auditor verifies the bank statement. That's the normal procedure. But in case any fraud means, let us say the bank statement itself is manipulated. Then this procedure may not detect that. Are you getting?
Yes, sir.
Right. Suppose entity shows I have this much of fixed deposit. So auditor can ask for fixed deposit certificate and verify. So this is a physical verification procedure applied. Auditor tests, okay, this is physically verified, it finds it or not. Okay. But let us think a different situation. Suppose these certificates are manipulated. Fake certificates are printed and shown to the auditor. Then it will be difficult to detect. Is it not? So point here is that the procedures which are effective on detecting error may not be effective in detecting fraud. So auditor need to recognize this concept also. Okay. Is it clear?
Yes, sir.
Now, having covered this, we'll be covering certain risk factors of fraud. And for that purpose, we are classifying the frauds into two categories. One is fraudulent financial reporting. That means a fraud in the reporting areas. Second is misappropriation of assets. That means assets are misappropriated. Okay. But in both the categories of fraud, following factors we'll see, or you can say risk factors of fraud. That is, what are the situations where an auditor feels that the risk of fraud? One is incentive or pressure. Second one is opportunities. Third one is attitude or rationalization. Okay. If these situations are there, so there is a possibility of fraud in financial reporting, and there is also a possibility of fraud in connection with misappropriation of assets. Okay, are you saying these three situations? 1, 2, 3. Can you read it out? First one. What's the first one?
Incentive and pressure.
Incentive and pressure. Let us understand its meaning. I'll be explaining you subsequently again. Incentive and pressure means if situation is like that, an auditor finds that situation is like that. If one fraud is committed, there is an incentive. Our entity will be benefited. Or there is a tremendous pressure on the entity to commit a fraud. Or let us say there is tremendous pressure on the entity to, let us say, overstate the sales figure, overstate the revenue. Or if the revenue is overstated, there is a substantial benefit. So auditor needs to assess the situation. In that situation, if auditor finds, so there is incentive if fraud is committed, and there are pressures on the entity to commit fraud, then you can say that those financial statements are more prone to fraud. Did you understand? Did you understand?
Yes, sir.
Okay. Similarly, if there is opportunities, so entities such that there is enough opportunity to commit fraud. Let us say so many sisters concerns are involved and there are transactions between them. Then it is very easy to most of the cases to manipulate the revenue. Right? It is their sisters concern. One may raise a sale bill. Right? So it will be sold as a revenue in one organization, purchase in another organization. So here situation is that there are opportunity. So when these kind of opportunities are there, then also there is a possibility of fraud. Did you understand the second situation?
Yes, sir.
Attitude of the management and the rationalization of management. they are also important. So auditor need to form an opinion on the attitude of the management and what kind of logic they are giving, how they are rationalizing a particular situation, which are where there is a possibility of fraud or there is a possibility of error. Some managements maybe purposefully they might be willing to commit fraud, maybe in order to avoid tax or in order to, let us say, show up their picture. So that attitude, the auditor has to judge that attitude. If the attitude is there, then definitely those financial statements are prone to fraud. And rationalization, the kind of logic management is giving. Okay, management may be explaining that there is no point in giving so much of tax. We can manage the tax, we can reduce the tax. These are some logic. They try to find out the rationalize their own bias. They are biased and they try to find out the justification for that. If auditor sees those kind of situation, then auditors should understand that there is a possibility of commitment of fraud. Did you understand the situation? Three situations I told you. Again, I repeat those things. First one I told you, incentive and pressure. There might be high degree of competition in the market situation. Let us say various entities are there and there is huge competition. Everybody tries to show up their figure. They want to show that our revenue is highest. Okay. If that is the kind of situation, then there is a possibility of fraud. One organization may fraudulently manipulate its revenue figure. Okay. That possibility is there. Did you understand the situation? Because there is competition and there are pressures. You might be knowing, have you heard of this? Many times you might be knowing many TV channels compete among themselves for TRP because they want to show that their channels, the TRP is high. Newspapers also compete among themselves to show their circulation. Is it not? So similarly, there might be possibility in the industry to show that my entity has got highest revenue, it has got highest profit like this. So if that kind of situation is there, then there is possibility of fraud. Are you getting? Are you getting or not?
Yes, sir. Yes, sir.
Yeah. Similarly, operating losses. If there are losses in the organization, and there is a possibility that because of loss, the company may become bankrupt, or there is a theft of bankruptcy, then it is natural in that kind of situation that entity will try to conceal that situation. Okay, operating losses are there, and company feels or the real financial position is such that it shows that cash flows are not sufficient to pay up the liabilities. Cash generation will not be sufficient, or the securities are insufficient, or current ratio which shows the short-term solvency is not in order, or asset coverage ratio which an example which shows a long-term solvency that is also not in order. So when the company sees this kind of, or the organization sees this kind of figures, or this kind of company makes this kind of analysis, so he feels there is a threat of bankruptcy. So maybe those kind of entities, sometimes they try to commit a fraud to hide that situation. Did you understand this example?
Yes, sir.
Okay, so these are incentives and pressures. Third situation, you see, need to obtain additional debt. Let us say company wants some debt. Company needs some debt. And the company's financial statement, for example, balance sheet doesn't permit that. Okay, doesn't permit that means debt equity ratio is such that banker will not give any additional debt. Or again, current ratio or the security position or the asset value of the asset is such that additional debt is not possible. So in that situation, it is again natural that company may try to manipulate the situation in such a way that manipulate those ratios, manipulate those balance sheets in such a way that the balance sheet will become bankable. So additional debt can be obtained. So when auditor sees there is a need to obtain additional debt, so auditor should again be skeptical. He should verify whether any fraud has been committed to make the balance sheet bankable or not. Are you getting?
Yes, sir.
Similarly, to comply with listing agreement, in case of companies whose securities are listed in stock exchange, they have to comply with certain norms. So in order to comply with those listing agreement, the company may be interested to manipulate the figures and commit fraud. So auditors should check those controls, that what are the key points which are required for listing agreement, and is to see those figures whether they are genuine figures or they are manipulated figures. Similarly, personal guarantee of debts of entity. Many times, some of you might be knowing that the directors and other key management personnel, they give a kind of personal guarantee for company's loan. Okay, to protect themselves. Many times they also commit, they may be tempted to commit fraud. A fraud might be committed to protect the personal guarantees. Did you understand the situation of incentive and pressure? So if these situations are there, so one can imagine there is a possibility of commitment of fraud. Do you have any query?
No, sir.
Okay. Now, next situation, as I told you, the second category is opportunities. Let us say there are significant related party transactions. That means most of the sales and purchases happens through related party transactions. Then there is a possibility one can manipulate the transaction. One can manipulate the sales and purchase figures because all are related parties. If I want to increase the sales, I can increase the sales. I have to raise a bill, other party has to transfer money. Okay, so they may be just book entries. So when there is significant related party transactions, there is opportunity. One can misuse that opportunity. So skeptical auditor needs to find out, okay, here is an opportunity, means there is a possibility of fraud. Then if significant estimates that involve subjective judgment or uncertainties that are difficult to corroborate, if the financial statement is such that it involves many things where judgments are involved, okay, and there are many figures which are subjective and which are uncertain, the management makes their own estimate and makes their subjective assessment. So if those kind of figures are there in the financial statement, so auditors should understand that there is opportunity to manipulate. Auditor needs to be extra careful to see that the financial statements are not affected by any fraud. Or there are significant unusual or highly complex transactions. And if it is difficult to find substance over form, okay, that means form of the transaction might be something else, but in substance it is something else. And there it is difficult to judge whether it is difficult to judge the nature of the transaction. That means what is the form and what is the substance? What is it in substance? So substance over form is a kind of judgment area. Auditor has to see that thing. Did you understand this? So these are some examples where opportunities are there. Consequently, there is a possibility of the fraud. Third, you see attitude and rationalization. I was telling you before some time that when non-financial managers excessively participate with the financial decisions, that is also indication of fraud. Okay, non-financial managers are involved, let us say, financial things. There is a possibility that fraud might be committed. Or By seeing the history of the organization, history of the entity, if we see there is a history of violation of law, you might be knowing there are some organization or some entities hardly you can find any violation. They honor the law. And you can also find out many entities who habitually violate laws. So if the history of violation of laws is there, then there is every possibility that this organization might have committed. Changes in lifestyle also indicate the possibility of fraud. That also shows the possibility of misappropriation. Okay. If you see some people, certain key management persons or people who are involved, who are given the custodian responsibilities, if the lifestyle suddenly changes, so that is also indication that asset might have been misappropriated. Did you understand?
Yes, sir.
Now you must have understood when we say auditor needs to be skeptical. So auditor needs to have a questioning mind for all the situations. He has to judge the situation. Auditor understands that fraud means there might be fraud in financial reporting. There might be fraud with respect to misappropriation of assets also. And these are the certain factors which indicate that there are possibilities of fraud. Incentives, pressure, opportunities, attitude, and rationalization. Okay, right? So now I'll be telling you
Yes,
the
sir.
circumstances, few other circumstances in detail circumstances that indicate fraud. Suppose you will become the auditor. So you need to understand that if these circumstances are there, that there is an indication of fraud. Number one, you can see from accounting records. So as an auditor, you are expected to verify accounting record. Is it not? Accounting records must be verified. Suppose you find situation like this, transactions not recorded completely timely. Meaning, when you go for visit, you find 15 days transaction have not been entered into. Transactions are not updated. So that is also indication fraud might be there. Unsupported or unauthorized balances. Some account, there are some balances are lying without any support. If you ask for the evidence, ask for the confirmation, that is not available. And those balances are also not authorized. Then there is indication of fraud. Last minute adjustments. You find that at year end, so many entries are there on 31st March date, so many adjustments are there. That also indicates fraud. The inconsistent access of employees to systems and records. Different people are accessing the organization system and records. Or tips or complaints to auditors. Many times when auditor visits, some other people gives him some tips. Tips means your information. Certain information or complaints that this thing has happened. Okay, so on the basis of the tips and complaints, auditor can have an idea that there is a possibility of fraud. Okay, so from accounting records, these are the indications. Similarly, conflicting or missing evidences, like missing documents. So documents are missed, they're unable to provide. You are asking for a fixed deposit certificate, but certificate is not produced to you. Or it appears that certificate has been altered. Or photocopy documents are produced in place of original, where you feel original documents is relevant, it should be available, but photocopies are produced. So that is also, those are also indication of fraud. Problematic relationships, meaning sometimes access is denied. You are asking for a record, but entity is denying that they will not produce that record. Sometimes you'll find undue time pressure imposed by the management. Management is always insisting to finish the audit. Please finish the audit within 7 days. So if there is undue time pressure, then there is also an indication of fraud. Unusual delay in providing information. We are going for audit. We are asking for a document, but everything is provided to you, but not that information. There is unusual delay or delay or denial to access IT operations. The entity is not allowing you to the information technology system. They are saying whatever you want, we'll give you, but we will not give you access to our operation. So this kind of relationships also indicate possibilities of fraud. Or unwillingness to meet privately. You want to fix a meeting, but the concerned person is not interested to fix the meeting. That means one-to-one meeting. He's meeting in public, but private meeting, that person is avoiding. That is also an indication of fraud. Variance in accounting policy. You find that accounting policies keeps on changing. Last year, they have recognized revenue in by following a particular policy. This time it has been changed. So you find there is variance or frequent changes in accounting estimates. Accounting estimates, suppose life of the asset. Every year the estimate keeps on changing. So these are the certain examples which indicates that frauds might be there. Did you understand this? Situations involving fraud.
Yes, sir.
Okay. So just a minute. So I think we got some broad area about fraud and error. We'll move to our one more part just now.